Okay, we just talked about how once we get the information from a client, we get their financial statements, and we kind of look through it and we see what exactly do we have here? Where are our challenges? Where are our opportunities? How can we more effectively organize these financial statements? So in this next segment, what we're going to do is we've already talked about how it's very useful on a profit and loss statement to be able to see what trends we might see on a month-to-month basis. But what becomes even more important is when we see how each of those amounts within each of those periods correlate to a percentage of sales. And so we're going to talk about that analysis and what information that gives us and how that'll help us make better decisions. Okay, this is our next step in our analysis. As you can see, we've taken a step to organize this profit and loss statement. And what we've done is we've inserted a column which is a percent of sales column. And so what this allows us to do is to say, like, okay, let's look at our sales, let's see how it trends. And we talked before about how there's some seasonality because this is a e-commerce company, and retail, they typically have big months in May and in November as they approach, with Black Friday and Cyber Monday. And so, but what's important is to understand how our business model reacts to the seasonality. So the cost of goods sold, what we like to see in this section is we like to see variable expenses. And so if they're variable expenses, that means that as sales increase, then also the costs increase. And that would make sense since this is a retail business, an e-commerce business, that the more they sell, the more costs they'll have because they ship more product. And so there should be a consistent profit margin, gross profit margin on each product they sell. So now that we have this information as a percentage of sales, we start to look at how the gross profit reacts with the seasonality of the business. As you can see, it starts out, somewhat consistent. We're around 64% to 72%. But now we get, as we see in July, we get down to 51% gross profit margin, which is a little bit of a red flag. We get 32% gross profit margin in September. In October, we're down at 15%. In November, we get way up to 64%. And then we kind of stabilize around 58%. So on the year, we average 60%, but we're kind of all over the place. So what's happening here? We see that there's a problem. And the problem is that we're on a cash basis accounting system. And so we need to move to an accrual accounting system to align the expenses to the revenues in the proper month. So that helps us understand some work that we need to do. As we go down to the operating expenses, we talked before about how the categories are a little inconsistent. A lot of times what we like to do is kind of highlight some trends. You would expect total advertising and marketing to be relatively consistent from month to month and maybe ramp up in the months where we have higher sales. And we can kind of see that, but we kind of get the sense that we're not capturing everything having to do with total advertising and marketing in here. There's some inconsistency with the way things are costed. We talked before about administrative salaries, how we don't have anything input for the year, and then all of a sudden we start to input things. And so we need to standardize on a good chart of accounts and have some discipline in categorizing each expense to the right account. We look at something like interest expense. We have a month here we haven't booked any interest expense, and then we have a month where we book a significant interest expense, and then it really jumps up. Did we originate a new loan here? What happened to this interest? Did we skip it? Did we make it up in a subsequent period? Again, this comes to accrual accounting. Even if we don't pay that interest expense in July, we want to see an expense in July because that's when it was incurred. Otherwise, our margins really jump around a lot, and we don't really understand the competency of our business plan. Marketing salaries, something else, we kind of look across and we don't have anything booked there until November. All of a sudden we have marketing salaries. Now, is it that we just hired marketing people at this point in time? Where were these marketing costs going before? Were they going to consultants? If so, we'd like to see that group, those consultants and the marketing salaries grouped in the same category so we can see how the marketing spend overall trends. Here's another, we look at payroll expenses. These hop around quite a bit. We've got all of a sudden we've got a payroll expense of $21,500 in September, whereas the prior month was only $11,000. And then October we're at $20,000, and then we're down in $12,000 in November. So what happened there? So there's some areas for concern, and we want to address these. And so this is all part of getting more intelligence out of the financial system. Now, we also have a balance sheet, and we're going to talk a little bit about how to get more information out of your balance sheet. Here, we can see that they've made an effort to categorize things. The main thing on the balance sheet is we want to make sure that we have sections for what we call current assets. Current asset is defined as anything that can be converted to cash within 1 year. And then we also want to have a section for current liabilities. And a current liability is anything that we need to pay within 1 year. And the reason why that's important is that we can generate a liquidity ratio, which shows how we're doing with our near-term cash resources. To the degree that our current liabilities are greater than our current assets, that's a problem. And so as we take the next step in our financial analysis, we're going to look at the balance sheet, make sure that all these groupings are correct, and we're going to generate some ratios to understand the health of the business. And so as we look at the profit and loss statement, this is where we assess the performance of the business. When we look at the comparative balance sheet, this is where we assess the health of the business. And so we'll go to the next slide and dive in a little deeper. Thanks.